Interest rates, the economy, what's going to happen for the Australian property market moving from 2025 and onwards. Hi, I'm Jaryd Krause. I'm the co-host of Property Pals Australia with
Sam Powell, the other co-host, Property Pals Australia. A lot of P's, but in this episode, Jaryd opened a can of worms in my brain, and it's just a bit of a teaser, but it's really important to understand, I guess, the long-term economic drivers of an economy to give you that confidence to move forward. And we discuss this. We break it down with, I guess, interest rates and government stimulation packages. There's a lot of interesting conversations in this episode, isn't there, Jaryd?
Yeah, exactly. And it's a cycle, right? That cycles continue, and we're in a certain cycle, and this certain cycle has been quite different, as you explained, because of what had happened in 2020 and the insane growth we had that led to interest rates rising, decreasing inflation, increasing inflation in different ways. And it is a can of worms, and it does get explained beautifully by Sam. And if you're going to be investing in property from now on in the future, already are in property, this is an episode I feel that you should not be missing out on at all.
Yeah, what's happening in 2025, and we will do a lot more of this, but enjoy, and we'll see you on the inside on this one. But as always, as we say, this is not the only way that we can help you for free. Definitely jump on the website, propertypals.au, and also check on the resources for our How to Maximise Your Borrowing Capacity mini course. And hope you get a lot out of it. See you on the inside.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Informal chat about the market conditions. Now, we don't normally do this, Sam, because we like to create evergreen content, but I think it's going to be an important one to share what's on our chest, in our head, around market conditions. There's a few things that I want to touch on. I want to touch on interest rates. I want to touch on grants, first homeowner grants. I want to touch on supply and demand in certain price brackets, and fill in the gaps between. And what do you feel that we should share between those things?
I want to start out. Is it informal or unformal?
That's a ChatGPT question for you.
Anyway, just taking a piss. There's some really interesting. Well, exactly what you mentioned. They're key drivers of markets, and they're like forward-looking indicators, is what I call them. Mm-hmm. So that helps me give the confidence. Obviously, I take it very seriously that property is an expensive asset to buy in and sell out of. So we do want to get it right, and looking a little bit deeper into like taking the FOMO out of your brain, and going deeper into, what's happening in this sort of broader economy, to help give you the confidence to make that, do you go in or do you hold? I'm trying to think of a poker analogy, but I don't play poker.
So, fold or hold.
Fold or hold. Yeah, fold or hold. Yeah.
I started to try and get into poker here in Bali, just to like make mates, and I suck at poker. Just giving money. I should just start donating instead of playing poker, to be honest. But yeah, so the reason I think this is valuable is because there's first homeowner grants, and there's interest rates, and there's talk about interest rate cuts. Been happening for a long time. There's always news about interest rates. And when I was at home a couple of weeks ago, I was speaking with my dad about interest rates and about first homeowners buyers grants, and how that has been affecting a certain price bracket of properties in Australia with the demand for those. And I also know somebody in my life that's looking at purchasing, and using some of those grants and acquiring an asset. And so it's interesting because, there can be certain areas where they can just be, with first homeowner grants, there's an incentive there for people to go away and buy something in a certain, I think the first homeowners grant is up to what, 700K at the moment?
Yeah, well, in Queensland, and the government's, the whole idea is to stimulate the lower end of the market because there's the thing called the ripple effect. So if you can stimulate that lower end, then that pushes prices up in that lower end, and then obviously everyone just keeps getting pushed higher and higher in price. So the government only need to stimulate one market to then obviously benefit the whole market. It's generally how it works.
Yeah. And so that means that there's incentive to purchase those properties under that price bracket of, say, 700K in Queensland. It might be different in different states. And then as people start to see interest rates possibly decline, I'm not sure if they're aware of it, but when that happens, is access to capital becomes easier. So more people can get finance from the lenders and acquire either larger assets, and or even the people that can't acquire a property yet start to get in on the discussion and the possibility of them purchasing, which also drives markets hugely, right?
Yeah, you're getting into some economic things here, mate, and it's the liquidity and access to I guess debt is a key driver to, I guess, the future looking indicators to growth, because it's just that, going back to the human psychology, or if you, as a owner occupier is the majority of the market, if they go to their mortgage broker, if they go to their bank, then I'd say let's have a chat to a mortgage broker. Give you a broader
we've got
access.
We've got a lot of mortgage brokers. If you guys want intros, let us know.
Oh yeah, well, I mean, once again, there's good, there's great, and there's rubbish in every industry. So please only talk to the good ones, or the great ones. This is my preference. If you don't know any great ones, then obviously shoot us an email, hello@propertypals.au, and I'll put you in contact with one of the brokers that we recommend. But that's not why I'm doing this podcast. The point being is the whole rationale, right? Is you sit there and go, you've got $1.1 million to spend. Like, you've got, call it 100 grand in, or 200 grand in cash, and you've got borrowing up to $900,000, Jaryd. So your budget for this property purchase goes so many different ways here. I'd be telling you, Jaryd, don't go to 1.1. That's maxing out your borrowing capacity. Let's go a bit lower and then use the rest for, investment. But all jokes aside, the 1.1 standard buyer goes, oh, cool, let's go shopping for a $1.1 million property. And then an interest rate cut comes along, or lending conditions sort of go a bit more favorable. So then they go, oh, wow, we can borrow $1 million, and we've got our 200K cash. So, we've missed out on these properties, for that extra 50 grand, we could get, an extra bedroom or another bathroom, or, the shed at the back, the emotional cycle. And then, then it goes, you find that property and they're asking, 1.15 million. And then there's other buyers on there, and you go, well, I've got 1.2 million to spend. Let's just do it. We've been in the market for 6 months. We've missed out on a few properties. The agents tell me 1.2 buys it. I trust him or her. You throw all your cash at it. That's the psyche that people go through most days. So when you do get those interest rate cuts, what it does is obviously you have to put less of your household income to servicing that debt, so you can therefore afford a larger, I guess, borrowing capacity, essentially. Does that kind of make sense?
Yeah, absolutely. And what that does is it stimulates growth in the market, especially in the lower end, because more people can purchase property now and start purchasing larger properties, which pushes up the value of property for property investors. So if you're already in property, it's a great thing. Also, that's a really good reason to buy property as soon as you can. while it's harder, because if you can invest in property whilst it's harder to have access to capital, you can really ride the coattails of that growth as, lending becomes easier. Yeah.
Yep.
And so how do you every time we talk about like macroeconomics off air, and you're big into it. You basically started to get me into it. And you've been looking at it for many, many years. How do you see, and we're not going to hold you accountable to this either, myself and all listeners. I'm just stating that on behalf of all listeners, like I have a say, which I don't. But how do you foresee, moving into 2025, the I guess as a whole, the Australian property market changing or not?
Yeah, 2025, obviously, this is what I'm seeing in the broader market. So Australia, we're a small fish in the world pond. The way that the world's evolved is, I guess, of late, the Dutch were the main power, and then the British came in power, and then America became, the dominant, and little old Australia, we're just sitting down here. So at the moment, we, some people have different beliefs. I'm still, in the camp of, we do lag those larger nations, and the confidence levels come from, especially America, like they're a big influence on the rest of the world. And the reason being is like their oil's traded in the US dollar, right? So people need to hold US dollars to trade that. So that's the dominant currency in the world. So when America changes their interest rates, it's it can be seen as a, I guess, leading indicator into what's going to happen in other parts of the world. So in September, America, they cut their interest rates, so they pulled back 50 basis points, so 0.5%. They brought it back. They're coming at a much, they're like in the 5% at the moment, so they've pulled theirs back. So Australia at the moment, their cash rate's at 4.35%. So there's still a fair bit just for America to come back to ours. But basically, we've all had that high interest rate environment where they've increased it after an extreme low. I mean, America were at 0%. Australia got down to 2%, or the cash rate was much lower than that. So what my understanding is, and even looking at there's a website called the RBA Rate Tracker. So that's basically people like looking at where's the cash rate going in the future in Australia, and that's trending down for 2025, and so is America. So what they do in the economy is with inflation has gone quite high. Like they raised interest, they cut interest rates during that whole COVID period because they wanted to stimulate the economy, because they wanted people spending, because that helps to keep that economy stable,
which increased inflation.
Yeah.
Right.
Well, to increase inflation, because it's like there's a lot of fear in that market where people are like, and rightfully so. Like, I don't want to get into this too much, but I mean, you lock down the whole entire world, you fearmonger every single person to, you're going to die. So, what do you think is going to happen?
Trying to hoard cash, but we need to make sure the economy still grows. So you decrease rates a little bit so people have a little bit more frivolous money, and that increases inflation. And then we get into a problem of everything costs too much, and we need to do something with rates. And they put them up.
Yeah. And there's a lag-on effect there of a couple of years, hence why, now we're here. So it's got to a point now in America and most of that Western world where it's hurting. People are hurting their back pocket, and the economies are slowing. And the economy is a massive beast, so it's always tinkering on, they're trying not to rise too fast or cut too fast, because then it's like a seesaw. You want it to be sort of balanced to have that, and that's why there's always that inflation target of 2 to 3% in Australia. So if they're cutting and rising, it's just like, whoa, and then you're losing, as a government, you're losing confidence. Like the people, the community
In
are
the
losing
economy.
confidence.
Yeah.
They're going, what are you doing, you dumbass? It's like, where petrol's $2.50, now it's, I filled up the other day, it was $1.60. I'm like, damn.
It's like crazy cheaper than where it used to be a year ago.
Yeah. Well, remember it used to be $1, mate, when we get out.
Let's not show our age, huh?
But then, so basically, like, long story short is, we're at that stage now, and this is the interesting thing too for me. So when governments are actually cutting interest rate, it's actually a sign of the economy's weakness. So they're trying to stimulate it.
Mm-hmm.
Where we are in Australia, like, our economy is really quite strong, because the way I look at it is, we're a self-sufficient island nation, rich in resources and education, and we're a really attractive, developed nation to migrate to. So we've got really strong ties with China and India, even the Philippines, Indonesia, like that. The Asian nations, and then you go deeper into, like, obviously we're colonized by the British, got that connection, Canada, America, like
Commonwealth.
I think Australia's positioned really, really well for the next, couple of decades, and that's why I was really bullish in that property space. But coming full circle is that you're seeing America, that they're starting to cut their interest rates. Australia's pricing it in. I mean, the RBA is saying that they're always they manipulate the markets through commentary these days, and that's sort of where the economy.
That's through news, is what you're saying, right? Through news.
Yeah, they'll talk about.
Yeah.
Oh, we might raise interest rates next month, and it's like, might, okay.
How they bake it in, right? They use the news to bake it in.
Yeah. So where I'm seeing Australia is in a really strong position at the moment. We're not hurting too much. I mean, employment's another interesting tracker. Unemployment rate.
Can I just add in there?
Yeah.
Because this is, when I came back to Oz a couple of weeks ago, and even when I was back in Oz last year as well, and people were there are people struggling in Australia monetarily, but when you're in your own struggles, typically you don't see other people's struggles because you're dealing with your own stuff. So I just want to say this for what you said, Sam, is that Australia's in a good position. And we're doing pretty well in Australia. That's comparative to other nations that most people in Australia may not actually realise. Yes, has been quite tough for the general population in Australia financially since interest rates have increased. I'm just suggesting, and probably feeling into what Sam has said, is like that's not compared to like the rest of the world, right? Is that what you're saying?
Yeah. Sorry.
Because I mean, there are people like are really like in Australia like struggling and hurting, and still don't realize like how hard it could be in other places in the world.
Yeah, that's a really good point. And like, I mean, in parts of America, like the homeless rate and the addiction rate is massive. And from a political standpoint, you can't have like civil unrest or rising civil unrest in your economy, because that creates conflict. And then if conflict gets out of hand, then as a political party, you only have a 4-year term. You're going to lose power. So it's not in their best interest. So that's why it's come to the point where, and this is this is a really interesting subject. This is where it goes deeper.
It's a big one. It's big.
Like, it's unprecedented. Like, the world has never coordinated a shutdown of ports and I guess the nations ever before. Like, and that's because of technology where we can communicate these things, and the risks. Like, I'm for all intensive purposes, like, the risks were real, and there was a lot of concern around that, and obviously people with bigger brains and knowledge, to obviously myself, thought it wise to do what they did, and it happened. But it's like you hear stories of the ripple effects of doing that, and especially with things like sickness. You think about it from a port, pick any port in the world. You sit there and go, well, you all can't come in because there's an outbreak of whatever you want to call it. So stay home, and then people get they catch a cold, and then they're not there for 2 weeks. But that's 2 weeks. Even if it's just 2 weeks, that's 2 weeks. Like there were stories of ships just lined up in the ports of Florida, like just basically just sitting there, and they couldn't unload. They couldn't do that. You stop the whole economy, like with produce and materials and everything. Like that doesn't just that takes a massive ripple effect into the rest of the world, and that's why we've seen that from 2020 to essentially now. And then you get people where it's like, oh, like I remember the times it was like, oh, I'm feeling a bit sick, stay home, don't come into work. And then you get people like even a few years, they're like, oh, I'm sick, I'm not coming into work because I know I can get paid, and I can just chill at home and whatever. So
it's an event that it has changed the world forever.
Yep. Yeah, and this is the new normal. But what that did is obviously they knew by doing that, and they needed to stimulate the economy, so interest rates were cut dramatically. And the long term trend has been down with interest rates, cash rate. So where does that sit? Like there goes into further like governments also utilize debt in their I guess their books. So when debt is cheap, it's also cheap for them, so that helps with their overall cash position. So it's similar to us as people, where you get lower cash rate, then you have lower repayments, and then if you have income coming through, then that enhances your positive cash flow essentially from that point of view. So when I go into, I guess, that cash rate is they cut it, and then it got to a point where, inflation, and it was always going to happen, and that's where you see asset appreciations. And that's why, during those 2019, 2020, 21 periods, I was doubling down and just leveraging myself out, because you don't get basically free debt.
And then knowing that that's going to lead to inflation and of property prices.
Yep.
So now where we're currently at is that we've had the inflation, and there's a lot of people that have been, it's the cost of living in Australia has been crazy. Like there's a lot of people with, as interest rates go up, you just mortgage repayments just go up and up and up and up, right? I was speaking to one of our mates about where he was at. I think he was at like a 2% interest rate or less, 1.8% interest rate, and then went to a 6 and something % interest rate after his his interest rate period had ended.
Yeah, your fixed rate period.
Fixed rate, yeah. It's just psycho how much more repayments were, and it's happened for so many people, which has made it difficult for cost of living for people, especially with families and a lot of debt. And so how do you see the property market changing based on if we are to get cuts and decent amount of cuts over maybe a year or two period? How do you see that changing for the spending of Australia? People in Australia spending money, and or the market, what that relates to in the property market.
Yeah,
and people that are property investors, like thinking about people that want to get into property, like is it good? Is it bad? Is it
it's never one thing, right? So it's not just interest rates. It's the combination of a few things that give me the confidence. So what I'm seeing is that we're still in an undersupplied market, and yes, the governments have come out and they're saying we're committed to more housing supply coming on. And that's like, it still takes years for that to actually come into fruition. And you can approve as many lots as you possibly can, but you still need builders and tradespeople to build these things. And you need developers to actually, pull their socks up and develop these lots of land to increase the supply. At the moment, so that because of it's at that peak sort of inflation, or we've obviously come off the peak, but it hasn't been profitable for developers, and it's a privatized industry. What used to happen back in, I guess, the 70s, 80s, 90s is like governments would actually contribute to the market through building houses for the, I guess, housing commission areas, as an example.
Government housing.
And they got out of that because they wanted to sort of keep it as an open privatized industry. But then they also increased all the regulations and taxes to make it less profitable for these developers to go and develop the stock. And developers, they're smart people. You sit there and go, well, I'll just buy this block of land and then land bank it, and that's what they've been doing. So I guess trying to get on full circle, because this could probably be like like a multi-hour potty.
Yeah, that's right. I've stoked the fire a bit. It's going off.
Yeah, I do want to put more around this, but it needs to be more thought out as a presentation to explain why. So I will get onto that. But yeah, at the moment, 2025, to try and build that is, we're in a low supply market. Populations, like, there's definitely been increasing, but we need to increase that population because we don't have we've got skill shortages and trade shortages, and people don't want to go and do these types of jobs like picking fruit or digging holes and things like that. Like, it even gets to a stage where, like, those professions, people are getting paid a lot of money to do very I guess, like, so careful what I say, like
non-glamorous work.
Non-glamorous work. And it's like, and that's where it's like, well, there's low barriers to entry, but it's sort of like, well, there's not enough people to actually want to do those types of jobs. So that increase the supply and demand imbalance, right? So it's like, if you're someone who is doing a job and you're like, well, I've got 40 people calling me wanting me to do the same job, so you put your prices up. It's just simple economics.
Exactly.
So the issue is that we've got a low supply market,
which means farmers and stuff have to pay those people more to get them in to do the roles.
Yep, and that leads to, and if you're, as a farmer, you're not going to go, well, I'm getting, my profit is X on this product. You increase the price of your product, and then the end consumer, being us households, are the ones that are feeling it, and that's what inflation really is. So it's got to a stage now where the governments, they are having to cut those interest rates because consumer spending is dropping off, and they're seeing the inflation drop down from its peak. I think it was like 7%, and now it's like they're wanting to get it down to its target band around 3% or below, but still a bit above that. But what that does is, obviously, they're trying to have this soft landing, is what they talk about, where it's still we're not going to go into a recession, because if they keep really hurting households, people, and this is why property is an investment class that I'm interested in, is because shelter is such a Maslow's hierarchy of needs. It's required, so people will do whatever they can to hold a roof over their head. But it's the discretionary spending that starts to hit, and that's been obviously impacted. And there's a lot of businesses that are around that, so they're trying to stimulate the economy by cutting interest rates. Australia is not there just yet. I don't think they'll cut this year in 2024. Maybe December. Like, they don't meet in January. They meet in February. And the December cut would be to stimulate that Christmas trade to help those suppliers on that front. But what's been the difference is that even for investors and people that own property, is it's easier to hold on to that asset. Like, sure, your repayments have gone from maybe $3,000 a month to potentially, $8,000 a month, whatever you're doing. But your asset price has gone from $1 million to 1.5 over the couple of years. So you sit there and go, well,
you got to keep paying because we want to. It's going to keep growing. Yeah,
your net return. So that's kind of like that's one kettle of fish. But then what governments are doing too is with that slowdown, because prices have appreciated so much on an asset value base, and that's where inflation too comes into it. Is it's inflation in cost of living, and that is also your housing and asset prices as well. So with a slight slowdown on that, then the governments start to go, well, we still want to stimulate that economy and give them incentive to buy. And you're getting the lower price people that are getting priced out of these markets. So they want to keep stimulating that because there is a real, like, the human desire for having their own home is really high. And that's why they incentivize people through stamp duty reductions, or for first homeowners they do first homeowner grants, especially the building grants the government put through. That's you're stimulating so many businesses by building a house, because you've got your builders, your plumbers, your sparkies, all your trades, your plasterers, concreters, everything, all those businesses to build one house. And then you move into the house, then you need furniture and you need all the other household goods and everything like that. And then you got all the insurance companies that have taken their lick as well. So it's really stimulatory for the government to focus in on the property side of things.
Yeah. And so how does that help or hinder two different types of people that are already investing as property investors and people that want to get in as property investors? How does it help or hinder them?
From, I guess, price growth is being in the market, targeting those for residential, those lower price points is a key aspect to get into. So that helps in price growth.
Okay, got you.
And rental price growth as well, because with supply imbalance, there's only so many places you can live at the moment. That's why we saw really strong rental growth come through, and that leads to price growth.
So basically, as the interest rates decrease and cash becomes more available for more people, then the demand for those lower type of assets will increase, right?
Yeah, well, people that couldn't afford to get into the market could potentially get into the market.
Yeah, especially with lesser interest rates and grants.
Yeah, so you're increasing your demand, essentially.
Yeah, which increases the value of the properties as more people can come in as well.
Yeah, and this is where it goes into, I guess, key location research too, which we'll talk with next week with Matt from HTAG Analytics. Is that the supply and demand is such a key fundamental, because if you've got an increasing demand and a stagnant supply, or even a decreasing supply, the balance is in favor of growth.
Which is what people is being thrown out there in the media around the housing, like the crisis, rental crisis and housing crisis. So you've got this narrative, and then you've got interest rates decreasing, cash being more available, or access to capital being more available, plus stimulus through the government to get people that on the low, like just getting into property as a first homeowner buyer. It's what's that going to do for the narrative of the housing crisis, right? Like it's a very interesting one.
Yeah, I mean, it's a watch this space, and it's been happening. Like it's been going on for forever. It's just what they do. Like house prices, they are, it's sort of inflation based as well. Like, but it's just one of those a fundamental metric to look at for growth locations is affordability. So Sydney leads that way, and that people have incomes, and yes, they're higher in Sydney, but also with technology too, you don't need to go and live in Sydney to earn a couple of $100,000 plus a year anymore. You can live anywhere and do that. So, but that leads that market in. If people are willing to pay, like say, to two-person income, they're willing to pay $3 million for a 3-bed 1-bath house in Sydney, then those two people, if they were living on the Gold Coast, could have the propensity and willing to do that as well. So that's why I don't like to target those mid to high end markets. I prefer to be those more affordable from a residential perspective, because you can hold that asset over multiple cycles and still get a good amount of growth.
Yeah, absolutely. Wow. There you go, guys. There's this. That's just a teaser. That's just like 3% of what Sam has for you in terms of macroeconomics. We've been chatting about this for many, many years, and I've learned so much from you. So I'm very grateful, Sam. And yeah, is there anything you want to add in before to cap off, or should you just say, guys, questions, like point them through to Hello House Property Pals.au? Oh, sorry, Hello House. Hello at propertypals.au.
You jump on Hello House as well. But the biggest thing is, I guess, the precedent of locking down the world and the ripple effect, like that has not been seen ever. So the price growth that you've seen in Australia from basically 2019 to now is unprecedented in my sense. In the whole of Australia, like the national growth rate, I think in 2022 was 20%, 22%.
So gnarly.
The average sits around 5 to 6%. So it's like, you don't expect that, and it's not going to last forever. And there's always going to be a moment in time where prices are they do need to come back. If you look at a price chart and go on any Google share price, like Alphabet, you'll see that they go up and they pull back, and they need to pull back to go higher. Like in an established market, that's how it happens. Point being is, we're entering back into a more normalized market after this sort of lockdown anomaly period of growth. So it's becoming more and more, you can't just buy anything and see growth, and that's what I think people are really, they do get FOMO. They get caught up in, oh, my friend made $100,000 a year by buying in Perth or whatever. It's not going to be like that anymore, and you don't want that, because I guess property is a long-term game. I want, you do want that. Obviously, you want the $100,000. Don't get me wrong, but if you're going to be doing that sort of that game, you need to be really entrenched in the data and in these markets and being a lot more active. So if you're an active investor, then yeah, sure, but it's an expensive thing to get wrong, and to get in and get out of. So I'd say more and more now, because we're reverting back to the sort of that normalized market, that the importance of analyzing location, suburbs, and the data around that is becoming a lot more prominent in that space. So make sure that you're working with someone who understands those supply and demand metrics in these locations that you're buying.
Exactly what we talked about on our last podcast episode around how to choose a buyer's agent.
Yeah. There we go.
Yeah. Awesome. Love it, Sam. Everybody who's listening, thank you for listening. And yeah, we'll see you on the next one.
Bye.